Want to know the secret to building wealth without a huge salary or some risky get-rich-quick scheme? It's not magic, it's math. And it all boils down to one simple question. When do you start? Picture this. You start investing just $200 a month, starting today. In 30 years, you could be looking at nearly $244,000. Now, what if you wait 10 years to start? You invest the same $200 a month for the remaining 20 years. How much do you have? About $104,000. That's less than half the money for the exact same monthly effort. Starting just one decade earlier could mean you end up with 2.35 times more cash. How is this possible? It's all thanks to the eighth wonder of the world, compound interest. Compounding is simple. You invest money, it grows. Then, that growth starts earning its own growth. And that new growth earns even more growth. The cycle repeats, and over time, the curve of your wealth doesn't just go up, it bends upwards, faster and faster. There's a neat little trick called the Rule of 72. Just divide 72 by your expected annual return rate, and that tells you roughly how many years it takes for your money to double. So, with a 7% annual return, your money doubles about every 10 years. This is why time in the market always beats timing the market. You can't predict the best days to invest, but you can give your money more years to work for you. Let's look at the numbers a bit closer. These examples assume a 7% average annual return and consistent monthly contributions. Of course, these are just examples, not guarantees. Real market returns will vary. So, you invest $200 every single month for 30 years. But here's the truly mind-blowing part. Let's say you invest that $200 a month for just the first 10 years. And then you stop completely. You don't add another penny. You just let that money sit and compound for the next 20 years. Your grand total? Around $134,000. That's right. You end up with more money than the person who invests for 20 straight years, but starts late. Why? Because those first 10 years supercharge everything. Your earliest dollars have the longest time to compound, so they work the hardest and multiply the most times. Think you don't have $200 a month? Let's start smaller. How about $25 a week? That's about the cost of a few fancy coffees. So how do you actually do this? First, treat investing like a bill you have to pay. Set up an automatic transfer from your checking account to your investment account. Do it weekly or monthly, right after you get paid. Automation removes emotion and builds the habit. But before you go all in, make sure you have an emergency fund. Start with $1,000 in cash. Then work your way up to 3 to 6 months of living expenses. This is crucial because it keeps you from having to sell your investments at the worst possible time when life throws you a curveball. Next, you need the right account. In Canada, look into a TFSA for tax-free growth or an RRSP for retirement. In the US, a Roth IRA or your employer's 401k are fantastic options for tax advantages. Wherever you are, find your country's tax-advantaged accounts. They save you a ton of money on taxes, which means more of your returns stay in your pocket. Now, what do you invest in? Forget trying to pick the next hot stock. Just choose a low-cost, broad, diversified index fund or an all-in-one balanced fund. This gives you a tiny piece of hundreds or thousands of companies, spreading out your risk. And pay attention to fees. A 1% difference in fees can cost you tens of thousands of dollars over 30 years. Fees compound against you, so keep them low. Under 0.5% if you can. But what about the common fears? I don't have enough money. Start with $20 a week. Something is always better than nothing. I'm too late to start. The best time was yesterday. The second best time is right now. 10 years from now, you'll wish you had started today. Market crashes scare me. That's where a strategy called dollar cost averaging comes in. By investing a fixed amount regularly, you automatically buy more shares when prices are low and fewer when they're high. This smooths out your average cost and helps you take advantage of market dips. Fear has cost people more money than any market crash. Ready for a 4-week action plan? Week 1. Open the right account. Week 2. Set up that automatic deposit, even if it's small. Week 3. Pick your low-cost, diversified fund. Week 4. Make your first purchase. And that's it. You are officially an investor. The math is clear. The earlier you start, the better off you'll be. So go open that account today. Automate your first $25. You've got this. Thanks for watching. If this helped, please hit that like button and subscribe for more simple financial tips. And hey, drop your country and your starting amount in the comments. I'll try to reply with a little mini plan to get you going. See you next time.